All right, let's go ahead. I want to introduce myself. I'm Debbie Duncan with the Center for Nonprofits. My colleagues Danielle Robinson and Kathy Hahn are on to help me in the background. And we're presenting today the Don't Miss Out on the Employee Retention Credit webinar. This is a very critical topic that we really need to make sure we get the word out and people understand what's going on. The Center for Nonprofits, let me give you a little bit of information about us. We are the New Jersey State Association for Nonprofits. Our functions are primarily fall in three areas: advocacy, which is educating legislators and lawmakers, the public, and our nonprofit partners like you about issues affecting nonprofits, what the laws are, how you can engage with your representatives and lawmakers to make sure that nonprofits are being considered in policy planning. We do education such as this webinar, but also we have a help desk, we have publications, and we hold our conference, which is coming up, and you'll hear more about that at the end. We also have a number of member benefits. We are a membership organization. We serve every 501c3 in the state, but we give you, our members get help desk access and more in-depth assistance. We have job postings. Our job postings are free. There are other cost benefits. So we encourage you to consider becoming a member if you are not already. We are also a member of the National Council of Nonprofits, which is the US-wide organization for nonprofit associations like us. They help us and provide us with resources, and they are here to help make things better on a national level too. Today, I want to welcome April Kushner, Joshua Chinaney, and Stephen Wolf, who are going to be doing our presentation. But first, let me give you a little bit of housekeeping. We do have closed captioning activated. So if you look on your controls at the bottom, you can activate that. We also have a chat window, and you can see who's participating. So please feel free to use that. In the chat, put your questions, any comments and questions you have. We will be holding questions until the end of the program. So I encourage you to write it down while it's on your mind. I know in my case, it does not always work out well. Okay, let me introduce April and Josh and Stephen. Stephen Wolf, who is recently retired as a tax counsel with the Jewish Federations of North America. He led their policy agenda on tax public policy before Congress and the Treasury. He specialized in planned giving and charitable organizations. He's a frequent lecturer, author, and he worked at some major public accounting firms most of his career. Currently, he's been collaborating with the National Council of Nonprofits on this particular issue of the employee retention tax credit. April Kushner is with Sachs LLP, Sachs has been a partner with the Center for many, many years. She was named partner in 2022 and is a key member of the firm's not-for-profit service. She's worked with clients in a variety of interests, but has a passion for working with the nonprofit organizations and helping them overcome challenges that they face. She has years of experience in auditing and reviewing various types of nonprofits, such as religious organizations, membership organizations, and social service organizations. Her expertise includes federal and state grant compliance and uniform guidance requirements from a variety of government agencies that fund charitable organizations. Within the firm, April also plays a vital role in training members of the firm's not-for-profit practice to ensure that they are knowledgeable about the industry changes and challenges that nonprofits are facing. Last but not least, Joshua Chineni is the partner with Sachs and leader of the firm's manufacturing distribution practice, concentrating on advising clients on key areas to their success. But he's also an active member of the firm's not-for-profit practice, specializing in auditing and advisory service to some of the firm's largest not-for-profit clients, social services, religious organizations, membership organizations. He specializes in governance and best practice on fiscal policy. So I want to welcome all three of you, and we will, I'm looking forward to hearing your information on this, rather difficult topic.
Thank you, Debbie. So hi, everyone. I'm April Kushner, and I'm here with Josh. Sachs did a lot of recovery webinars over the past couple of years with the COVID pandemic, which is why I pegged Josh over here as a good person to present with me on the topic of the ERC credit. This is something, too, that is not just for-profit companies, but it's also for nonprofit companies, nonprofit organizations. So we think it's a really good topic to talk to you about, to get all the information out there so you can take advantage of the credit if you haven't already. So thank you for having us today. We can go to the next slide, Debbie. Okay, so the employee retention credit. Is it really $26,000 per employee as everyone advertises? And if so, how does an organization qualify and how is it paid? Next slide. So the purpose of the credit was to provide financial assistance to companies during the COVID pandemic, including this employee retention credit. It was a number of different programs that had been issued by the government. It was established through the Coronavirus Aid, Relief, and Economic Security Act in March 2020 through the CARES Act to help businesses retain their employees. The ERC provides eligible employers with credits per employee based on the qualified wages and health insurance benefits paid. So can organizations still apply if they're eligible? Yes. The statute of limitations for 2020 for the ERC does not close until April 15, 2024. And the statute of limitations for the 2021 ERC does not close until April 2025.
Right. So why don't I take it from here? So the reason why I think, hi everybody, I should say this is Josh Chineni. Pleasure to be in front of all of you. So the reason why this is getting so much play right now is I think, originally when the CARES Act came out, it was you could apply for the PPP or you could apply for the employee retention credits. And it didn't come out until much later that you could actually apply for both as long as there was no interlap. And I think that's going to be the common theme of what it is, we discussed today. We're going to go through, how we calculate the credit, how much are we entitled to. But in the same breath, I think everybody's situation is unique. And I think this may or may not fit for everybody. And I can't say it enough, because your situations are all so unique. It's so important that you consult your own tax advisor, your own accountant, to make sure that this is for you. But like I said, this is out there. And as April said, asked the question in the beginning, is it really the $26,000 per employee that everybody advertises? The answer is yes. But does it fit for everybody? The answer may be no. So let's keep going, Debbie. Okay, so as we just talked about, if you receive the PPP loans 1 and 2, you can apply and receive the employee retention credits. And we did talk about before about what the dates were that you could apply for those credits up until. Oh, we lost the slides there. Oh. Okay, so there are some eligibility requirements here. So again, we're going to look at 2020 as 1 year of credit eligibility, and we're going to look at 2021 as a different year for employee retention credit eligibility. So what I want you to focus on is listed here. So in order to qualify for 2020, you have to be an employer with 100 or fewer average full-time employees, is defined as a small employer. And then for 2021, that number increases from 100 to 500. So based on your head count and based on the formula, you may be ineligible for 2020, but eligible for 2021. Let's go to the next one. So an employee with any calendar month had an average of at least 30 hours of service per week, or 130 hours of service in the month, is determined to be a full-time employee. So when you go ahead and do your computation, this is what you have to look at. This is not necessarily the same full-time equivalent formula that we had for PPP, so just keep that in mind. Okay, so next slide. Okay, and just right also here, so an employer that operated its business for the entire 19 calendar year determines the number of its full-time employees by taking the sum of full-time employees in each calendar month in 19 and dividing that number by 12. So again, like I said before, there are some unique things with respect to this. So certainly, consult your own tax advisor when you go to apply. Okay, so let's keep going. So there is no limit to the extent you're an eligible employer. If, however, you had greater than 100 full-time employees in 19, you can only include wages paid to employees not providing services. For 2021 credit, if you had greater than 500 employees in 19, you can only include wages paid to employees not providing. And again, remember, this is overage. For companies with fewer than the previously mentioned 100, 500 full-time employees, then you can include wages paid to all employees. And I think for us, and most likely the nonprofits associated with the center, you're going to fall into that bucket, and you're most likely not going to be limited. Okay, so if we are eligible, this is the max amounts available of credit per employee. We go to the next slide, Debbie. Okay, so for all of 2020, and I should justify that by saying after March 15th, 2020. So really, when we go through the computation, the first quarter is not included, but we can get up to 5,000 per employee. And then for 2021, we're able to look at individually by quarter to claim the credit, of which a max per employee we can get is $7,000. Now, the infrastructure bill that came out in the latter part of 2021 took Q4 2021 off the table. However, Stephen is going to speak later as to the lobbying efforts to maybe hopefully, knock on wood, reinstate that. So again, here's how you come up with the 26,000 per employee that everybody is advertised. Okay. Okay, so eligible businesses, both for-profit and not-for-profit, as April said, that experienced a full or partial government order suspension of operations, or, right, so in this case, you don't have to meet both criteria, experienced a significant decline in gross receipts in any quarter, more than a 50% decrease in 2020 from 2019, and more than 20% in 2021, could receive a quarterly refundable payroll tax credit, which is the employee retention credit. So again, remember, you don't have to meet both. The next slide, we're going to go back and revisit this first part. Okay. So this is the area, in my opinion, and I'd love for Stephen to interject here as well, that I really believe is getting the most play, right? Because with respect to revenue decline, it's black and white, right? You either meet the requirements or you don't. This is where people are really taking a very hard look. The wording included here is the wording from the original CARES Act. If you go to the IRS's website and search for employee retention credit, there are definitions there that speaks to each one of these areas, right? So I'm just going to read it for everybody on the call. It says, the operation of the trade or business described in Clause I is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to the coronavirus disease, the 2019 COVID-19. So, like I said, in our world and our clients, this is what everybody wants to talk about. In their eyes, has everybody been affected by this in some capacity? Sure. But again, I think it's important to go in, read the definitions, and again, make sure that this applies to you. Stephen, if you're on, do you, in your efforts, I would imagine you've come across this a lot.
Right. Yeah, it's a very, very good point you're focusing on, Josh. I think that for many businesses and nonprofits, the full or partial suspension probably applies for the year 2020. Now, it's important that you can point to a specific government order to back up that suspension, not just a voluntary suspension or a voluntary diminution in your activities. So I think that for 2020, that is pretty clear. Now, while the same wording applies for 2021, I think a lot less government authorities were providing those orders for 2021. So I think it's a little bit more difficult to meet that standard in 2021, which is why the gross receipts test becomes a heck of a lot more important for 2021. However, having said that, there probably are some organizations that can still meet the partial or full government order shutdown.
Yeah, thanks, Steve. That's really well said. And I think, for me, every morning I check my email and there's an article in Accounting Today or one of these other accounting publications that, was talking about how the IRS is challenging these credits, much like the PPP loans, for abuse, right? So I would say this, and I'm sure Stephen would agree, if you believe you meet this purpose, right, and you meet this restriction, that you document, because chances are, the IRS, because they've been made to look silly in this whole process, is going to challenge, especially the larger credits. I mean, I would think, being a smaller organization, do I want to say benefits you in this situation? I'll never say yes, but I believe the IRS will certainly attack these credits, and I think we're seeing it just by how long it's taken them to actually pay the money out. I think as time continues to go on and we move further away from this period, right? We talk about 2020, we talk about 2021. There is much more scrutiny on the eyes of the IRS. So we're going to talk about how long it takes, really, with respect to expectation to get this money. But I can't advise you enough to make sure, and Stephen said it best, look at your revenue reduction first. If you meet it through that, fantastic. If you look further to this, to this exemption, make sure you meet the criteria. So just wanted to spend a few minutes there because, again, when you hear the advertisements on television or on the radio, or you getting bombarded in your inbox, the companies who are helping organizations calculate these credits aren't doing the due diligence, aren't doing the background, asking the right questions for you to see whether or not you meet this criteria. All they're saying is, we'll do the calculation for you. This money's out there, the credits are available, and that's all we're taking responsibility for. And you're going to pay them a real hefty amount to do it. So again, I can't stress it enough. We're having these conversations every day. Please make sure that you really qualify. So
exactly like it says here, it's very subjective. So it's something that can really be scrutinized if that's the route that you're going to go.
Right.
Yeah, and also to that point, as you mentioned, Josh, in the IRS's several pronouncements on the ERTC explaining and trying to amplify what the statute means, they do have several concrete examples of a government ordered suspension of operations. So again, especially for 2020, make sure you document, go back and find the order by the city council, the mayor, the county council, the governor, or the federal government, et cetera, which says these operations will be suspended. And again, it's suspended just partially, not in full. And that's also a very, very big point.
Yeah, and I think there's going to be a big push on their part, just like how we're having this meeting virtually, we've created a virtual environment to do business. And I think the IRS is going to use that as a point, right? So, how are you conducting your consulting sessions or your programs? If you're able to really do it virtually, are you really limited in your ability to operate? So I know that's been a key area that they, at least what I've heard. Now, unfortunately, we haven't had any clients get scrutinized yet, but I'm sure it's coming. We read it in the newspaper every day. So it's only inevitable. So Debbie, let's go to the next slide. Let's talk about revenue decline. Okay, so when we talk about decline in gross receipts, we're talking about everything, right? Throw the kitchen sink at it. It's all program-related revenue, which includes all your grants, contributions, program fees, membership dues, and all of your investment income, dividends, interest, capital gains, any rental income, royalty income, and what us accountants like to call other income for whatever the weird things are that necessarily don't get categorized. It's basically everything, right? So everything that you report as income on a quarterly basis gets captured in this computation. And another thing that's important is when the IRS looks at this, we look at it on a calendar quarter, right? So for purposes of this test, we look at calendar quarters, which may or may not, if you're a fiscal year taxpayer, correlate to your fiscal quarter. So make sure you calculate it on a calendar quarter basis. And just as it says below, based on safe harbor guidance released by the IRS in August 2021, the PPP forgiveness does not get included as gross receipts for purposes of this computation. So that's the only thing that I'm aware of that you can exclude from this computation. Okay. There we go. Okay, perfect. So just other random facts. Again, so if your accrual basis for financial statement purposes and for income tax purposes, that's how you calculate this. If your cash basis for income tax purposes, that's how you calculate this. The ability doesn't exist to change your method of accounting in order to meet the criteria. So that is certainly one of the things that the IRS is going to look at. They're going to look at your 990, they're going to look at your financial statements and see what your taxpayer, what your accounting policies are. And then the other thing too is it's not reduced by taxpayers adjusted basis in certain property used in a trade or business or capital assets sold. So again, probably not going to make a difference here, but that is certainly something else. Okay. So how do you compare gross receipts? So we're going to focus on 2020 first. So you compare gross receipts, as we said before, per quarter to determine if a 50% decline has been achieved. So again, as I said before, reminder, the ERC is calendar quarters, not fiscal quarters. So in effect, this started after March 15th, 2020. So we look at the quarters. We look at Q2 2019 versus Q2 2020, Q3 2019 versus Q3 20, Q4 2019 versus Q4 20. So you have to achieve a 50% decline in one of those quarters in order for the eligibility to start. 2021 is a little bit different. Okay, Debbie, next one. Okay, so, because this comes up a lot as well. So for 2020 ERC, once a company has a 50% decrease in revenue for a quarter, are they eligible for ERC for the remaining year? Are gross receipts applied to each quarter separately to determine eligibility? So the answer to that question is a company will at least be eligible for the following quarter. Okay, so if in the second quarter of 2020, you hit that 50% decline, you're automatically eligible for Q3. Under the gross receipts test, the company will remain an eligible employer until the quarter following the quarter, which the gross receipts decline reaches only a 20% decline as compared to the same quarter in 2019. So if we hit the 50% right in quarter two, we're automatically eligible for quarter three. If the receipts continue to go up, as long as we remain basically below 80% in Q4, we're eligible for the whole period. And why that's important is because when we calculate the credits for 2020 and we're trying to achieve that $10,000 of eligible wages, we actually have the ability to go back and pull from the prior quarters. Again, I'll say it, assuming we're not double dipping and in nonprofit cases, triple dipping between the ERC that's going to reimburse payroll, essentially, the PPP that's going to reimburse payroll, and C, your funding that has direct reimbursement for people's payroll. Okay, next one. Oh, that was a mouthful. Okay,
Josh,
so yes.
That last point, you're referring to like government contract reimbursement kind of stuff?
Yeah, sure.
That's a very, very key point in the nonprofit area. I think that needs to be pointed out, because in a lot of cases, that funding source from government contracting is in fact the source of the funding. So your point about the triple accounting is very, very important. I think it should not be overlooked. Yeah, and that's great, Steve. And I think, you know, as we've worked through this with certain clients, you know, they've laid out and demonstrated, and really, I think it's the only way to do this is to chart the payroll as to how it's been funded, right? Because if you think about it in the grand scheme of things, from a risk standpoint, the PPP, albeit 1 and 2, is a one-time, right? Is a one-time revenue. The ERC is a one-time revenue. The funding source, most cases out of 10 are annuity-based revenues, right? So I don't know, and again, we haven't seen it yet, but the funding source has the right to look at this and challenge the allocation, and so does the SBA, and so does the IRS, right? So you potentially have 3 different parties that could look at this. So again, if you think you meet and you're able to cut this up between the 3 different sources, God bless you, but just make sure that it's documented. So as I said before, 2021 is a little bit different than 2020 because we have the ability now to go and get that credit on a true quarter-by-quarter basis. So in order to be eligible for 2021, you compare gross receipts per quarter to determine if a 20% decline has occurred.
So they actually gave us a little bit of a present here where they actually allowed us to, for first quarter 2021, actually go back and look at the prior quarter. So if you actually meet a 20% decline in Q4 2019 as opposed to Q4 20, you actually are eligible for the first quarter of 2021. With that being said, you could also look at the first quarter of 2019 versus the first quarter of 21 to be eligible for Q1 21. You look at Q2 2019 versus Q2 2021 for Q2, and Q3 2019 versus Q3 2021 for Q3. And as we said before, as of right now, there is no credits eligible for Q4 2021 unless you're actually a startup entity. So, but for those of us that have been in business a long time, as of right this minute, Q4 is not on the table. Okay. So, how do we calculate, right? So we take gross wages, right, plus employer paid health insurance. So those wages are capped at $10,000 per quarter times your applicable ERC credit percentage. So remember, if it's 2020, it's 50%. If it's 2021, it's 70% of that 10,000. You can receive a partial credit if eligible wages are below 10,000 in a quarter. So if in 2020 you only had 8,000 of eligible wages, you could still get a $4,000 credit for that employee. And with the same thought process, you can receive the 70% pro rata in 2021. Just like with PPP, 1099s are not included. And again, the credit is calculated for employees who receive a W-2. So let's say you hired somebody from a temp agency and you reimburse the temp agency for those, for the fee for that employee. Those are not eligible wages for purposes of this. Okay. So how do we claim the credit? So for 2020 and 2021, the only way to claim the credit is to file Form 941X. So you actually claim the credit on your quarterly payroll tax return. It actually comes back in the form of refunded employer Social Security, Medicare. This is the only way to claim the credit. There used to be the ability to go and request advance money on the credits, but that beginning of January 2022, that's now no longer available. So this is the only way to claim the credit. Next slide. So who can help me claim the credit, right? So your accountant or CPA firm, again, they should be knowledgeable about the credit and how to calculate it. And when I mean knowledgeable, it's walking you through the criteria, not just the revenue decline, but again, understanding, as Steve pointed out before, that partial suspension, partial government shutdown, and really what that means. Again, if your accountant or CPA firm is helping you, if they're amending the payroll tax returns for you, which they can do, the payroll tax returns do not have to be amended by the payroll tax provider. Certainly they should know and understand, how to file payroll tax returns. The payroll service provider, who's filing those returns on your behalf anyway. And then again, you can amend previously filed payroll tax returns. So if you filed a tax return, if it was amended for whatever reason, you can actually re-amend the payroll tax return to claim this credit. That is not, that is not off the table. And as we said before, beware of companies who are not qualified and could be scammers. These are folks who are just going to calculate the credit, whatever your wages are. They're going to file the tax returns on your behalf, but they are not going to do the proper due diligence with you to actually see whether or not you meet the criteria. So again, just be very cognizant of that. These same people, the people are getting calls all day long. They charge a very hefty fee, and God forbid something goes wrong or you get challenged, they're not going to be there, to help you through the process. So understand it's very costly, and it could be very costly if you wind up paying the fee, applying for the credits, receiving the money, and then ultimately have to pay it back. Again, I can't encourage people enough just to be smart about this, ask the questions. It sounds so good. And in a lot of cases, especially in ours, it could be too good to be true.
Hey, Josh,
Yeah.
just want to point out quickly, in the instructions to the amended 940X, there is a worksheet that can help an organization go through and figure out roughly the amount of the credit. Now, again, you're going to have to do all those computations, as you've indicated, regarding wages to individual employees. But once you've got those totals, then there is it's a 2-page worksheet. I think the third page, the second page is really focusing on the ERTC. So it can it should show you roughly what the amount of the credit could be. But your payroll provider and you guys can probably do that in spades. So
Absolutely. No, that's a great point. Great point. Okay. So does the IRS have the right? Oh, okay. So how long does it take to receive the credit? So, based on our experience, it's taking approximately 6 months to 9 months. I guess the 9 months got cut off there to receive a refund from the IRS after filing an amended 941X. We have seen in just up until this week, the smaller credits seem to be getting processed much quicker. So it may not take 6 to 9 months. But the bigger credits, the ones over 250,000 are taking longer. And I think that's the number that the IRS is using with respect to, a little more scrutiny than just cutting the checks. Now, what does a little more scrutiny mean? That's a great question. And, every time you call up the IRS to get information, they're very, very vague with what they tell you. My own personal opinion is that they're trying to do a background match to see that the payroll that's actually being reported, is able to be traced back to W-2s. They may even be matching it with tax returns to see that this is the payroll that was reported, and that they're not getting blindsided by scammers just creating fictitious payroll, like kind of what happened with the PPP. The other thing here too that I don't know I can't remember if it's on the slide or not, is when you fill out that 941X and you request the credit, you don't indicate actually whether or not you meet the gross receipts decline or this other exemption. So we're really just filing the 941X with the IRS requesting the refund of the credit. So again, it could be the IRS, again, fact checking, looking at numbers of what's been provided. At this point, they have the 2020 tax returns, they have the 2021 tax returns. So again, are they matching? Maybe. I don't know that I have the answer. I don't know, maybe Steve has the magic answer, but that's just my speculation.
Yeah.
Hey, Josh, I think you're right on point. We've heard that between 200 and 250 is sort of the magic number, which gets sort of pulled aside. We've heard that credits of less than $100,000 are being processed fairly quickly, and those are being sent back and credited to taxpayers' accounts. There's been pressure from the Hill to the IRS to work on the backlog. The backlog got almost to about 500,000 941Xs that were on backlog and not being processed. That backlog now is down, I think, to less than 200,000 returns that still need to be processed. It's still a hefty backlog. The IRS is working at it from two ways, processing the backlog, but certainly working at it in terms of increased audit resources. We've heard that as of September or so, additional audit resources were put on to the ERTC to look at the potential for inflated and/or bogus claims. So, and the IRS just came out with more information about this in an information release last week, an IR notice, which I think is on one of my slides. But you're right. I think the good news is that the process is going a little bit smoother. But again, make sure you've got your ducks in a row when you're claiming this credit. You can't emphasize that enough.
Yeah, and I think that's actually on the next slide, right?
Yeah.
I think I stole this from the, from when we did the PPP webinars back in March and April and May of 2020. Document your position, because again, understand that they may not question this now, but if they do 3, 4, 5 years from now, you don't want to be going back and trying to, pull all the documentation and remember what happened. So absolutely do that. And I think on the next, one more slide. So again, does the IRS have the right to challenge my application? Absolutely. This isn't a handout. On the for-profit side, these credits are taxable. On the nonprofit side, fortunately, they're still not. But again, remember to document your position. And I want to mention one more thing before I hand it over to Stephen, because I think I left it out of the slides. If you use a PEO and your employees are technically employees of the PEO, whether it's ADP, Insperity, one of the other ones, you do have the ability to claim the credit. They have their own guidelines with respect to how to claim the credit. So contact them, and they will certainly be able to direct you as to how to do that. But again, just because you're with the PEO and you don't have the ability to amend your own tax return, it does not preclude you from getting the credit. So Steve, I'm going to pass it to you.
Thanks. And Josh and April, you made some very, very good points. And I hope we're not coming off too negative on the ERC. It is out there and available. And if you've suffered either from a suspension of operations and or a decrease in operations gross receipts of only 20% in 2021, claim the credit again, but document and watch out for these fly-by-nighters. But look, using firms like Josh's, I think will stand you in good stead. Let's just spend a little bit of time on what we can do potentially to expand and reinstate the ERC for fourth quarter 2021 and perhaps even with 2022. It's quite Congress almost always has a lame duck session after the election. So the elections will take place next month or next month, and depending on what happens with the House and Senate, that may impact the extent and the size of a tax bill, but there probably will be a year-end tax bill regardless, even if there's a change in control in the House and Senate. There are issues like the child tax credit versus the research and development credit that need to be worked out, and there could be some compromises. Many organizations like the National Council and other large nonprofits are lobbying for this year-end tax relief. And at the same time, because of the numerous natural disasters that took place this summer and in the fall, Hurricane Ian and others, a disaster tax package is probably going to be under consideration. And in those packages, it's normal to extend charitable giving relief, both in terms of the time to claim the deduction, perhaps after year end to April 15, remove the AGI limitation on deductions, and also potentially allow some deductions above the line as there were for 20 and 2021. We are also lobbying heavily to reinstate the employee credit for the fourth quarter. As Josh indicated, it's not in the law for the fourth quarter. We've got some pretty substantial bipartisan, bicameral support, over 100 co-sponsors in the House, about 15 co-sponsors in the Senate to reinstate it for the fourth quarter. We're also pushing for extension to 2022 and expanding the credit availability in terms of making the gross receipts test more responsive for nonprofit organizations by changing some of the categories of receipts that would be included, as well as increasing the amount of expenses beyond wages that might be included. I think many nonprofits are facing some employment challenges, losing employees. So looking at issues such as wage considerations, other types of considerations to get employees on the payroll to be part of the ERTC calculation. So that's the genesis of what we're trying to do. And if we go to the next slide, we can see where some of those lobbying information can be found. The National Council on Nonprofits is one of the organizations leading this effort. We did a lot of lobbying on this back in the end of 2020 to expand the credit, to make it more available and better for 2021. We have a lot of resources, and I've listed on the page of the National Council's website where you can go to find this information, this lobbying information. It's listed under natural disaster tax relief. It includes both the charitable giving incentives I talked about, as well as the expansion of the ERTC. On that site, you'll see a sample letter you can use to send to the House and Senate. In New Jersey, can be a mover here, especially Representative Gottheimer. He was a key representative working on the budget in 2021. He's a natural target. I know that the Center of New Jersey has been lobbying, but if individual members can do this with these sample letters, also very, very helpful to both the House and the Senate. We've also included on that page some sample social media posts. There's also a sample press release. There's an article you can use in any of your information that you make available to your members in your organizations, as well as op-eds you might want to send to local papers, etc. Again, anything we can do to raise the level of this issue, get it on. It's on the agenda for the tax committees, but we want to make sure that when they consider year-end legislation, they consider the fourth quarter 2021, as well as expanding it to 2022 potentially for the ERTC.
If I can just jump in a second, I just want to mention that Linda and several other nonprofit groups, including somebody from the National Council, has met with Bill Pasquarello yesterday. He's a congressman from North Jersey. We have ongoing meetings and try to influence, keep in touch with our elected representatives. So any of you, your organizations who do have advocacy, personnel or initiatives, do keep in touch with us and let us know what you're seeing, what you're hearing, and how we can help, or perhaps how you can help partner with us to strengthen the voice of New Jersey nonprofits.
And thanks, Debbie. Bill Pasquarello, I forgot to mention him. He's a key member of Ways and Means. He is a key chair of a subcommittee on Ways and Means. Very, very active voice, sends a lot of information, letters to the IRS and Treasury, asking for information on this issue to ensure that the ERTC is being administered fairly and as quickly as possible. Very, very good point. Thanks for mentioning that. My last slide sort of confirms what we talked about IRS audits. Again, last week, the IRS sent out a warning letter in the form of an information release warning employers about these ERTC mills, if you will, and some, the improper ERTC claims. And from the for-profit side, they want to ensure that organizations realize that the amount of the ERTC has got to be calculated in the 1120 or the other income tax forms in terms of wage reductions that can be claimed against income. That's not an issue for us as nonprofits. However, as we've talked about during the course of the webinar, the IRS is working pretty diligently on this issue. I think both to get claims out, but also to look at large claims, those are especially over $250,000.
And Steve, if I could
Sure.
add something too, so we have all these companies out there charging, tremendous dollars, 15 to 20% of the credit that you request, and however you pay that is, obviously is different for every of these providers who's doing it. But now you see kind of these second tier lenders now advancing money against your outstanding 941 claims as a means to get people cash, who really need it. So, and they're charging tremendous fees as well, and requesting all sorts of guarantees. So there's people out there making a lot of money on this. So just, beware of, any of these contracts or deals that you enter into. So it's, a lot of these folks are still out there preparing the amended returns, doing the calculations. It's now shifting to these lenders who are making big fees on advancing money against the pending credits.
I couldn't agree more, Josh and April, but I gotta say, guys, maybe one more time. I spent a lot of time at the end of my work with the Jewish Federations in North America, lobbying to ensure that nonprofits were eligible for both PPP. And then at the end of 2020, working for the second round of PPP, as well as working to improve the ERTC. And as you pointed out, most folks claim PPP and not ERTC because that was the bigger bang for the buck first time around. However, I just want to reiterate that there's a lot of money still on the table that can be legally claimed as long as you've documented and not double or triple dipped your wages. It's money that you're entitled to, the organization is entitled to. These were lifelines for nonprofits in 2020 and 2021 and can be very, very important in 2022. I agree, I wouldn't be paying any organization upfront, at an exorbitant interest rate to against a claim for the money. However, work with organizations like SACS, work with organizations that you've worked with in the past, your tax accountants, your law firm, potentially your payroll provider, document it as you say, because there is money there. And if you can help us in this lobbying effort, again, we can make the credit even better. And there are folks like Stephanie Murphy on the Ways and Means Committee and Maggie Hassan from New Hampshire on the Senate side that are working to make this a better credit for nonprofits.
Wonderful. Can I jump in again? This is Debbie. Just want to let people know that there are the Center for Nonprofits has what we call our resource lists, where we have nonprofit experts in a wide variety of fields, from marketing to board development to strategic planning, etc. And one of those, of course, is accounting. As I said, SACS has been a partner of ours for a long time, but there are other accounting services that if you need somebody, we can give you some recommendations for people that we know have that expertise in the nonprofit sector.
Right.
So we have, I do have a couple of questions. We had a question saying that if you're a behavioral health provider and you cut your census to comply with social distancing, is that a qualifying factor?
I would say go back and look at the definitions, and see whether or not that fits. I think,
Gray area.
well, you know what? I think there's a lot of examples out there that may give you an answer to that question. I don't know. Again, I think it's on a case, I would go back and read the rules. That would be my suggestion.
Yeah, and I think in a lot of cases in 2020, especially in the second quarter and third quarter of 2020, there were a lot of organizations that could not conduct their operations the way they were normally conducted, perhaps like this example. And there was, and there probably was a government, again, city, state, county requirement that prohibited you from meeting in person, having your annual meeting, maybe knocking on doors and providing services, etc. So that could be an example of something, quite frankly, that would meet the either full-time or partial shutdown of a portion of your operations. Again, it's not your entire operations that shut down, but if you couldn't do certain things and that impacted the way you conducted your operations, you may have that, again, under a government order, you may have a qualification, at least in 2020.
Another question is from Tia Scott about the actual dates. They are on a July 1 to June 30th fiscal year. So would they be looking at April to June, and then July 1 to September 30th, et cetera?
So the way the IRS looks at this is purely on a calendar quarter basis, right? So you kind of throw your fiscal years out the window and you match the calendar quarters as per the IRS guidelines. So
and it's the same quarters that your 940 and 941 returns are based on.
Correct.
So that would be ending March, June, September, and December.
Yep.
It may not match up the way you figure out your 990 if you're doing some sort of quarterly computation there. Yeah, it's another complication, but something that may be well worth the effort, right?
Yeah, absolutely.
Okay, great. I don't have any other messages in the chat. We don't have a large group at this point. If anybody would like to unmute and ask any other questions, we're happy to address those. And as I have here on the slide, you can certainly get a hold of April, Josh, and Steve. I have his contact information coming up to ask further questions. Does anybody wish to unmute? All right, I don't see any more questions. This is a dense topic, and we will be sending a follow-up email with a link to the recording, so you can share this with your colleagues and look at it yourself again. We'll be sending you a copy of the slides, a PDF of the slides, as well as some of the links and resources that have been mentioned here. And again, you can reach out to the center too if you have any other questions or needs or concerns about this and many other topics in nonprofit management. So I'm going to thank all of you for this very dense topic, as I said, and I just want to point out a few things about the center. One of the things, as I mentioned before, we do advocate on a federal, state, and local level. Right now, obviously, we're encouraging nonprofits to get involved in getting out the vote efforts. And again, communicating with us if there are issues that you see in terms of policies and activities on both the local and through the federal level. I just want to point out too that we have our Trends and Outlook report. We do this survey every year, so we have many years of it. But this can be helpful for you in terms of getting information about specifically the New Jersey nonprofit sector. It might be helpful for educating your board. It might be helpful for applying for funding. And it certainly would be helpful for public education. So keep that in mind. They're all on our publications page. For our members, we had started quite some time ago, and it's been very successful. Our member Mondays networking video meetings, these are not very structured, where we want to hear from people and share information and resources among our members who join us. We also have, don't forget our calendar. Okay, we have upcoming events. Here are a few. Tomorrow, we are offering another webinar on investing and planning for turbulent times. And this is for organizations that want to look at, prepare for strategic planning, for possibly building up that rainy day fund, or if you want to have or have endowments, there's going to be a lot of good information here. We have presenters from a wide variety of different areas and organizations. I want to mention that Rutgers, the New Jersey Small Business, I forget, it's D, it's not A, but anyway, they are offering a symposium on business community engagement, and it's next Wednesday, November 9th, and we encourage you to look into that. Also, the Association of Fundraising Professionals of New Jersey has their conference on Thursday, November 17th on philanthropy. And again, it's a good, valuable resource for information on fundraising. But there are many more. Look at our calendar. And of course, we have our conference coming up. We're back again in person at the Palace at Somerset Park in Somerset, New Jersey. We are trying to keep our rates, in-person rates, very low, as we did during the pandemic for the virtual conferences. But there also are scholarships available. Our sponsors, one of the things our sponsors provide to us are scholarships for people who cannot afford to attend the conference on their own or their organizations. And so I also want to recognize the sponsors we have listed here, and there are more to come. So the conference will be featuring, it will run from 8 to 5 p.m. There are over 12 workshops. We have a couple that still haven't solidified yet. There'll be networking opportunities. We have some exhibits. There'll be a reception at the end, which is what people really enjoy. During the conference, we'll be offering both breakfast and lunch. And also, we are going to be attentive to people's health precautions. We'll be following whatever guidelines the CDC has, but also trying to make people comfortable depending on their own level of need and health status. Finally, our keynote speaker, we're really excited and eager to hear him. Mako Marquette Whitlock is the founder and CEO of Mindful Techie. Now that in itself, I think, should be of interest, but he's looking at in the post-pandemic nonprofit workplace, how are we going to continue to take care of ourselves, stay inspired, and thrive? So I think you'll find that anyone would find that pretty helpful. So I want to thank, again, here's contact information for Stephen Wolf, for April Kushner and Joshua Chinaney of Sachs LLP. And we really appreciate the time and the information that you are giving to our constituents. As I said, this webinar is being recorded and will be on our YouTube channel fairly soon. So thank you all again, Steve, April, Josh, really appreciate this. And we hope some of you will join us tomorrow on our other webinar, and we appreciate the support that all of you are giving to the center, and we are here for you. We want to be able to help you in any way that we can. Have a good rest of the day, and I look forward to hearing from you soon.